Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. Investing in the S&P 500 is pretty easily one of the most popular forms of investing advice you'll come across online. After all, it's an index of the top 500 companies in the United States, so a lot of people view it as a very easy way to diversify your money and get exposure to some of the strongest companies in what's historically been one of the strongest stock markets in the world, with even Warren Buffett himself encouraging investors to just stick their money into an S&P 500 index fund.
Buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
If anyone followed that advice, it's worked out pretty nicely for them. Over the last 50 years, the S&P 500 has seen an average total annual return, so inclusive of dividends, of 11.1%, which is pretty good and actually outperforms the majority of equity-based actively managed funds. But as you might have heard, there's been some growing murmurings over the integrity of the S&P 500 and whether it's still a diversified investment. You see, given how well this simple strategy has worked out over the years, we've seen a lot of money start tracking the index, with there being $7.1 trillion directly linked to the S&P 500 as of 2021 year end. Which is actually double the amount it was 3 years prior. And that's led to the concern that all this money flowing into these index products is inflating the value of its constituents, namely for the largest companies by market capitalization, which increases the risk of concentration, that just a handful of positions will dominate the performance of the overall index. For example, last year, a group dubbed the Magnificent Seven, which includes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, alone accounted for roughly 2/3 of the entire index's return for the year, which you can really see the impact of when you graph the performance of the S&P 500, excluding these 7 positions. Now, this is far from the first time we've seen alarm bells rung over the S&P 500 and even index investing as a whole, with a lot of active investors criticizing the practice for impacting price discovery, with the idea being that if all these investors, this $7 trillion of money is just being parked into these companies without any real fundamental research, it's going to lead those positions to become inflated and could contribute to a bubble, given that we aren't seeing buying and selling activity based on the company's fundamentals or research into the business. With one paper in 2016 even claiming that index investing was worse than Marxism, which is a pretty alarming claim. But it's always been important to take this alarmist commentary with a grain of salt, given not only that the S&P 500 has continued to perform well over the long term, but also that active investors have a very clear conflict of interest here, which is that index funds have actually taken away a lot of their business given their cheaper fund structure. So of course, an active fund manager who's losing business is going to claim that their competitor represents the end of capitalism as we know it. Still, we have seen the concentration of the S&P 500 increase over time, so there are some valid points being raised here, and there's also a lot of misconceptions about what investing in the S&P 500 entails. So today I want to address the diversification concerns, describe the situation, and hopefully put it into perspective, and then also highlight some important details about how this compares historically to what we've seen with the index. And to be perfectly clear, so I don't misrepresent the situation, no, none of this is to suggest that investing into the S&P 500 has suddenly become a bad or risky investment. Only time will tell whether it outperforms or underperforms other strategies, but it's really not as dire of a situation as some articles might suggest. Still, if you're going to put your money into the S&P 500, you should be aware of what you're buying and what you aren't. Because despite being synonymous with index investing itself and the idea of passive investing, you are sort of making some active calls when you put your money into the S&P 500. So in today's video, we'll cover all of that, as well as how it compares to other indexing strategies. But let's start by addressing the diversification concerns. As a market cap weighted index versus say an equal weighted index where every constituent is given an equal share of the overall index, the S&P 500 gives a larger weight to companies with higher market capitalizations. So the larger the company, the bigger its representation in the index and the bigger its impact on that figure. And a lot of people have always argued that that makes sense to represent the stock market that the index is trying to gauge. Because if companies like Apple and Microsoft are the biggest companies in the United States and have the largest impact on the market, given the sheer size of their operations, then they should have a higher representation than a company that, say, has much smaller operations. But over time, we've seen the market capitalization for these companies outpace the earnings they achieve, meaning there's been an expansion of their valuation. As an example of this, last year, the Magnificent Seven, who are all part of the top 10 companies by market cap, accounted for 28.6% of the S&P 500's market capitalization, but is only expected to make up 19.5% 30% of the index's earnings for 2024. In other words, larger companies are becoming more expensive relative to smaller companies. Now, a lot of this could be related to the hype around artificial intelligence. You might have noticed that the Magnificent Seven stocks all pretty well involved with artificial intelligence and are trying to incorporate it into their future business models. So it could be justified that the reason these stocks are more expensive is because they're more likely to see higher growth in the future, given that they're playing in this space. On the other side of it, though, some fear that this is the result of a sort of positive feedback loop resulting from index investing. Price of a large cap stock increases, which increases its weight within the S&P 500, which leads to more index investing dollars going towards that company, which further increases the stock price and its valuation, repeating the cycle over and over again. And we have seen this phenomenon where the largest constituents of the index have grown faster than the rest of the participants, leading to more and more concentration among them. For example, the top 10 positions of the S&P 500, or just 2% of all companies on the index, represent roughly 1/3 of the entire index's market capitalization, which is essentially the highest it's been since the 70s. And it's most evident when you look at the top 2 positions of the index, Microsoft and Apple, which alone represent nearly 14% of the entire S&P 500. And because a lot of these companies are within the IT and communication sectors, which historically were actually in part a single category, we've also seen sector concentration increase, with those two representing 38.4% of the index, despite them being just 2 of 11 categories. And that's really the crux of the situation. The S&P 500 is getting more and more concentrated around just a handful of positions across just a couple of sectors, and those positions are more expensive than much of the rest of the index, which could raise concerns that investors are getting more exposure to expensive stocks. But before reaching a verdict on this, it's worth highlighting some other important details. For one, with the S&P 500 still accounting for roughly 80% of the entire US stock market's market capitalization, it is still roughly representative of the US stock market. Now, we've highlighted the drawbacks of market capitalization given that it's a valuation-based metric and can deviate from the actual operations or size of a company or how much money it's making. But nonetheless, even with some issue there, with 80% of the market being captured, these 500 of the roughly 4,000 publicly traded stocks are still going to be representative of most of what the market is doing. Secondly, it's worth highlighting that this isn't the first time the S&P 500 has been top heavy. In fact, there's been periods in the past where it's actually been more concentrated. The weight of the top 10 positions in the S&P 500 peaked above 40% back in the 1960s, and even stayed above the 30% level up until the mid-1970s, with more recently it peaking above 25% during the dot-com bubble, versus today where the top 10 represent 32%. So yes, that is higher than perhaps the long-term average that we've seen, but it's not outside the historical range that we've ever seen for concentration. Thirdly, the S&P 500 is far from being the most concentrated index out there. Other indices for Germany, China, and other investable markets actually have a much higher concentration among their top 10 positions, with us here in Canada likewise having a higher concentration, with the top 10 representing 36.6% of our S&P TSX Composite Index. So from that standpoint, the S&P 500 isn't doing too bad. Finally, while a lot of people take comfort in buying the S&P 500, given that it gives them exposure to, again, 503 technically different stocks, just because some companies have multiple share classes, you don't need 500 different stocks to be diversified in a given market. A lot of research highlights that the marginal benefit of diversification to standard deviation, or how much the portfolio moves around, really tapers off after 20 to 30 positions, meaning that after that point, you're not further stabilizing your portfolio by adding more positions, or at least not meaningfully. So roughly speaking, an equity portfolio would be considered diversified on the generous end of things if it had less than 5% of its money into a single position. Now, it is worth highlighting that Apple and Microsoft do violate this, both having more than 5% of the overall index, but it's far from a detrimental allocation. Yes, there's a bit of an overweight here, and that could become more of a problem if these positions continue to outperform, which would benefit you, but nonetheless would increase the risk from that point moving forward. At just 13% of the overall portfolio, it's not yet at a level where we're severely seeing diversification hampered. On top of this, while the top 10 positions for the S&P 500 are likely more correlated, something that matters for diversification since it makes it less effective, S&P Global actually posts data on the S&P 500 constituents correlation over time. And at a current 0.18, you can see that there's still some diversification benefit to the index. So that should address the worst concerns over diversification diversification. Now, there are deeper, longer running debates over, again, whether index investing is causing asset bubbles, especially with those larger cap positions. We have addressed some of that in the past, with a big caveat to that argument being that active trading activity still far outweighs passive trading activity. So while yes, a lot of people are buying and holding positions, it's that active trading that will contribute to the price discovery, so long as that still outweighs the buy and hold activity of the passive investors. And yes, there is a chance that as the valuations expand further and further, we could see a correction of the top positions of the S&P 500 as more active investors sort of arbitrage into the space and correct that mispricing. And maybe we see a period of underperformance as a result of that. For example, the S&P 500 saw a total return average of 6.2% a year from the end of 1963, roughly when that concentration had peaked, to the end of the 70s. But over the very long term, despite these periods of weaker growth, we've still seen the S&P 500 see a double-digit total return figure. And given that index investing still has a cost advantage over active investing, it doesn't really poke a hole in the viability of the S&P 500. Nonetheless, this is where I want to highlight some of the fine print to investing in the S&P 500, because while that is sort of synonymous with the idea of passive index investing, as mentioned, when you decide to put your money into the S&P 500, you are in some ways making an active strategic call, whether you know it or not. For one, while the S&P 500 is often highlighted as the top 500 companies by market capitalization, that's not always true, strictly speaking. The index is actually a committee-determined index, meaning that there are people who will decide based on a list of criteria whether a stock gets to be included or not. And that comes with a bit of discretion on their part. The other criteria, in addition to market cap, includes having positive as reported earnings, adequate liquidity, and there's even a bit of discretionary sector weighting involved. So that's the first point, is that again, the strategy involves a bit more discretion from the committee and in terms of this criteria than you might expect as a passive investor. The second point is that in buying the S&P 500, you are clearly making a bet on larger cap stocks outperforming smaller cap positions. Now, over the last decade, we have seen larger cap positions outperform, in part because we've seen their valuation continue to expand. The law of research suggests that over the long term, smaller cap positions tend to earn a larger return. In fact, if you compare the S&P 500 to the S&P 600, which is actually a small cap index of 600 small cap US stocks, yes, the S&P 500 did outperform over the last 10 years, but over the last 30 years, the S&P 600 has outperformed by an average annual 4.5% on a price basis. Now, that's exclusive of dividends, which the S&P 500 would be paying more of, but regardless, on a total return basis, the S&P 600 would still be ahead. And as for why we see this, there are two sort of theoretical explanations. The first being that smaller cap companies tend to have an easier time growing their operations than a large company that's already well established and more mature. And secondly, the larger cap companies, again, tend to demand a valuation premium, meaning that a lot of their future growth is already baked into the current stock price. So whereas a smaller cap company has room for both earnings growth and valuation expansion, larger cap companies have already seen their valuations expand and are already at an elevated level. Which brings us to the final caveat worth highlighting, which is that clearly the S&P 500 means that you're actively betting on the US stock market versus international stock markets. Now, I know investors love the US stock market, and there's good reason for that. It's been a very strong performer historically, but you are still buying into what is one of the most expensive markets globally when there are a lot of opportunities internationally as well. The US stock market, for example, currently represents roughly 60% of the global stock market capitalization, despite the country only representing 25% of the global economy measured by GDP. Now, stock markets and economies are not directly comparable, so we are in some way comparing apples and oranges here, but it does still go to show that the market is relatively expensive. Using PE multiples, for example, or the price of a stock relative to the earnings of the underlying company, the S&P 500 currently trades at an average 24.2 times versus the Canadian S&P TSX Composite at 16.5 times, and many other international markets which trade at much cheaper valuations. Now, does this mean that the US market's glory days are behind them? Well, maybe, I don't know, but no, not directly. Yes, valuations are stretched, and that does mean there is a risk of contraction, but there really is no predicting the future. There's no telling how long stocks could stay at this sort of elevated level. I highlight all this not to say that the US market or the S&P 500 are going to underperform, but just to highlight that if you put your money into the S&P 500, while you might view yourself as a passive investor, you are still making some active bets. You're essentially betting that US large market cap positions are going to outperform, with a particular weight towards IT communication, and more specifically, Microsoft and Apple. And I want to emphasize, none of this is to hate on the S&P 500. I think it's been a great option for a lot of people. There's a good reason to buy into companies that are profitable and have a strong developed moat and almost monopoly in some of the industries they operate within. But that is the thesis you are betting on. Now, perhaps you're someone who wants to take advantage of index investing, but doesn't necessarily like the idea of making those active calls and just wants more broad market exposure. There are a lot of options even within just the US market for different sorts of allocations. The S&P Supercomp, for example, includes the S&P 500, the S&P 600, as well as the S&P 400, which is a mid-cap index to capture more of the stock market. It is still a market cap weighted index, so you are still going to be top heavy with those positions, but perhaps less so, and you'll also get exposure to those smaller cap positions. There are also other indexes with an even broader reach than the S&P indices, such as the Russell 3000 and the CRSP or CRSP US Total Market Index, which actually includes 100% of the US investable equity market. And even within the S&P 500, there are equal weighted funds where you still get that large cap exposure, but you split the money more evenly across all the constituents. With this fund having outperformed the normal S&P 500 on a total return basis over the last 20 years, albeit there are periods where the normal index is ahead. So it could outperform, it could underperform, only time will tell, but another option there as well. And internationally, there are a lot of indices you can have an index fund for as well, whether it be for a specific country or a globally diversified one, such as the MSCI World Index. So it's worth researching all the options out there and all the different indices, as well as all the different index funds, because you don't actually put money directly into the S&P 500, you're buying a fund that tracks the S&P 500, so it's worth looking into things like the fee that fund charges. Obviously, you want to minimize that as best as possible, as well as the tracking error of the fund, because some funds don't perfectly mimic the index. So the smaller that figure, the more closely the index fund copies the index in question. So certainly with all this, the concentration risk is something to be aware of. Again, to know that you do have that higher exposure, but that can be mitigated in any number of ways if you want to, or you can just be aware that that's the bet you're taking and that might work out, it might not. You might outperform in some years, you might underperform in others. But generally speaking, if you are broadly speaking diversified, which I still think the S&P 500 is, it's still a viable option, and you should generally be happy with the market returns you see. Anyway, that's the video. Thanks for joining me today. I hope you found it helpful. If you did, please make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on investing in the S&P 500. Obviously, hate to say it, but not financial advice. Really try not to influence people's decisions. Just lay out the details so you can come to your own conclusions about what index investing strategy works for you, if that's the approach you want to take. Thanks again for joining, and as always, be safe out there.